As we head into the weekend, the U.S. markets are closed for trading on this Saturday, November 15th, 2025, but the story for Navitas Semiconductor Corp., ticker NVTS, was all about Friday's action. The stock finished the week at $8.11 per share, closing the session with a strong-looking gain of 2.53%, or 20 cents. That's a nice green candle to end the week. But this single-day jump is one of the most misleading data points you could possibly look at, and it perfectly hides the brutal reality of what this stock has just been through. The expectation, the narrative you've been sold, is that Navitas is a pure play on the future of power. The reality? This $8.11 price tag comes after the stock has been decimated, falling more than 50% from its recent high of over $17.79, which it touched just back in October. That 2.5% gain on Friday isn't a victory lap. It's a desperate gasp for air after a catastrophic earnings report just 2 weeks ago sent the stock into a free fall, shedding over 22% of its value almost overnight. So if you're looking at Navitas as just another high-growth semiconductor name, you are missing the entire story. What we're actually watching is a high-stakes, all-or-nothing corporate pivot that is either an act of genius or a fatal miscalculation, and the market is justifiably terrified. Let's get right to the center of this. The common belief about Navitas is straightforward. They make next-generation power semiconductors, not the old boring silicon, but the advanced materials, gallium nitride and silicon carbide, that are supposed to power everything from electric vehicles and solar inverters to, most importantly, the massive AI data centers being built out by companies like the Nvidia stock bulls are always watching. The expectation is that as the world electrifies and demands more efficiency, Navitas as a pure-play leader in these materials will be a core holding. Maybe one you'd even buy through Fidelity Invest or a SoFi Invest account and just sit on for a decade. This is the story that took the stock from a 52-week low of $1.52 to that high of $17.79. It's a powerful narrative. Now, here is the reality that narrative completely ignores. On November 3rd, Navitas reported its third quarter 2025 results, and it was a bloodbath. The expectation of high growth met the reality of a 53.4% year-over-year decline in revenue. Read that again. Not a slowdown in growth, a collapse. Revenue came in at a meager $10 million, and if you thought that was bad, the company's guidance for the fourth quarter was even more terrifying, a projection of just $7 million. This would represent a 61% further decline from the same period last year. This is the data that matters. This is why the stock imploded. This isn't a dip, it's a fundamental break in the business. So what on earth is happening? Management isn't hiding it. They are calling this Navitas 2.0. In the plainest terms possible, Navitas has decided to intentionally walk away from its largest existing market, the low-margin, high-volume mobile charger business, primarily in China. They are, in effect, setting fire to their current revenue stream. The justification for this insane-sounding move is that this old business was low margin and that the real future is in high-power applications, AI data centers, performance computing, and grid infrastructure. The entire bull case, the entire reason for this company to even exist, now rests on this strategic pivot. They are voluntarily blowing up their own financials in the short term, betting everything that they can conquer these new, more profitable markets before they run out of time, and just as importantly, cash. This is where the recent stock movement becomes so fascinating. That 2.5% jump on Friday, that wasn't a recovery. That was bottom fishing from investors and traders on platforms like Robinhood or Interactive Brokers, betting that the worst of the post-earnings panic is over. The trading volume has been immense, with tens of millions of shares changing hands daily as long-term believers are shaken out and new speculators jump in. The stock is in a technical no-man's land, with analysts completely divided. The consensus rating is a lukewarm hold. The bears see a company with collapsing revenue and a negative PE ratio, trading at a ridiculously high price-to-sales multiple. The bulls are ignoring all of that, and they are focused on one single shining catalyst: Nvidia. This is the entire bet. The Navitas 2.0 pivot is aimed squarely at the AI revolution, and the company scored a massive validation point when it was recently recognized by Nvidia as a key power semiconductor partner for its next-generation 800-volt AI factory architecture. This is the why behind the pivot. The old 48-volt data center power systems are wildly inefficient for the kind of power that AI servers demand. The new 800-volt standard is the solution, and it requires advanced power chips that silicon just can't deliver. This is where Navitas's technology comes in. They are developing brand new 100-volt GaN and high-voltage CIC products specifically for this 800-volt ecosystem. The expectation is that if they can become a core supplier for this new AI infrastructure, the pittance of revenue they just abandoned from the mobile market will look like a rounding error in a few years. Let's briefly touch on what this company actually does because the tech is central to the story. Navitas is a leader in what are called wide bandgap semiconductors. Traditional chips are silicon. Navitas's are gallium nitride and silicon carbide. These materials can handle far higher voltages, temperatures, and switching frequencies than silicon. Their GaN-fast chips are integrated circuits, meaning they combine the GaN power switch with the drive and control electronics all on one tiny chip. This is what allows for those tiny, fast-charging phone and laptop chargers. Their Gina C line uses a proprietary trench-assisted planar technology to create robust high-power chips for industrial motors, solar inverters, and electric vehicle drivetrains. In short, their products make electronics smaller, lighter, faster, and dramatically more energy efficient. The technology itself isn't the question. It's fantastic. The question is whether they can build a business around it before going broke. This brings us to the future outlook, which is a landscape of extreme risk and extreme opportunity. To fund this painful pivot, Navitas just completed a $100 million private placement of common stock on November 7th. They had to. They are burning cash, and they need a war chest to fund the intense research and development to compete in these new high-power markets. As of their last report, they have about $150 million in cash, but they are not alone. This isn't some open field. They are now going head-to-head with absolute giants, companies like Infineon, ON Semiconductor, and Wolfspeed, all of which have deeper pockets, established customer relationships, and massive manufacturing scale. Navitas is the small, nimble innovator trying to outmaneuver the titans. This is the ultimate test of expectation versus reality. The expectation is that you're buying a piece of the AI and electrification future. The reality is that you are buying a company in the middle of a gut-wrenching bet-the-company transition. The financials for the next 2 quarters will likely be appalling. The headline revenue numbers will be terrible. Any investment in this name right now, whether it's in a personal individual brokerage account or part of a strategy like Schwab Intelligent Portfolios, is not an investment in their current earnings. It is a pure speculation on the success of Navitas 2.0 and the adoption of the 800-volt data center. It's a bet that the Nvidia partnership will turn into massive, tangible orders and fast. I want you to weigh in on this. Comment below if you think Navitas's Navitas 2.0 pivot to AI data centers will succeed, or if you think they are abandoning their main business far too soon. As we close, the picture of Navitas is now clear. That $8.11 closing price isn't the story. The story is the tension between a narrative of a high-tech future and the brutal reality of a business in turmoil. The market expected a smooth growth ramp. It got a strategic implosion. The expectation was a simple semiconductor stock. The reality is a high-risk venture capital bet. Management has made their choice. They've burned the ships, abandoned the mobile market, and are paddling furiously towards the shores of AI. Whether they find a continent of riches or a barren wasteland is the question that will define this stock for the next 3 years, and it's a question that right now, no one can answer with any certainty. Disclaimer: This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you. Don't forget to like, comment, and share this video to support the channel.